Assalamu alaikum dear. A very good day to all of you. My name is Sayyid Zaki Ahmed. I'm a finance tutor. To understand finance, please see that this lecture is taken till the last because these topics interest, future value and present value. They are the foundation stones of finance. So any advanced lectures will be dependent on these things, understandings for the students. Please subscribe my channel for and press the bell button to get my further advanced lectures. Now students, let's understand the concept of the value of money and interest first. For that we have to consider an example. Let's consider you have $1,000 or rupees, whatever currency you have, and you keep it in a box separately in your almirah and lock it up. At the Let's say you keep it at the end of year 0, rupees 1000. Similarly, at the end of year 1, you check it, it is still the same 1000. You don't add anything, neither you take out anything from this money. Similarly, it remains the same in the box at the end of year 4 also. Now, let's consider a commodity rice which we use on a daily basis normally. So, let's see the prices at the end of every year. The rate per kilo rice, let's assume, was 150 at the end of year 0. It was 168 at the end of year 1, and it was 190 at the end of year 2, and similarly the rate goes on till year end of year 4. Now with this current rate, you have this 1000 rupees in your book. How much can you buy at the end of every year now? Same 1000 rupees in your box. Let's consider, so in a rounded value, we get 6.7 kilos at the end of year 0. Got it? Now at the end of year 1, we can buy the same commodity for 6 kilos for 1000 with this rate. At the end of year 2, with the same money and this rate, we can buy 5.3 kilos. And similarly, you see, we go up to 4.2 kilos with this prevailing rate at the end of 4. Now, your buying power every year for the quantity of rice is going less and less every year with the same money of it. So, to buy the same quantity of rice, 6.7 kilos, you would be requiring at the end of year 0 1000. That is the same. At the end of this, let's say you keep this quantity as a fixed quantity now. Now, every year you can buy this 6.7 kilos with this prevailing rate. You can buy 1120 rupees. Similarly, you can buy the same 6.7 kilo quantity with this rate, 1266.7 kilos rupees rather. Similarly, you need this much money to buy 6.7 kilo rice. Similarly, you would be needing this money 1573 to buy 6.7 kilo rice at the end of year 4. So you see, the buying power is getting less and less. The money value is rising as the price and the inflation rises with the time. This is the kind of thing we want to actually check with this. Now, if you see the percentage rise every year, you see this is about 12%. This to this, we have 13.1% rise and 11.05% rise from year 2 to year 3 rise. So in this way, we have this quantity rise. Let's assume this percentage rise every year. Let's assume this is the increase every year. So it means the money value will have to rise if you keep $1,000 every year slowly and gradually. So the money basically if kept in a bank will rise with the rate of interest available in the bank which they give normally. So you understand the concept of interest which is going to be very important in finance in future. Now we will just define interest. In the most simplest words, interest is the rent taken by the lenders on the monies given to the debtors for his use or for a particular period. Normally it is a year. This is the service charge for the using the money for the particular period. And the amount of money lent is called principal and the rent charged is called interest. Generally, the interests are of two types, simple interest and compound interest. We generally don't deal with simple interest in finance because practically we are dealing always with compound interest factor. But in the next lecture, I am going to explain what is interest for your knowledge purpose. Now, viewers, let's discuss simple interest. In this simple interest, you see the table below. The principal amount remains the same and the interest is charged on the same principal every year. Now, if I point to, you see this is the interest percentage at the end of year 1. We are charging 10% and the value becomes 110. Similarly, we are charging another 10% on the same principal. Again, we go to the value is 10. So the principal plus the first year and the second year interest becomes not principal, rather balance. See, the principal remains the same, but the interest keeps on increasing every year on the same principal. This type of interest normally is not mostly used in finance. We use compound interest for our interest because that is the more practical side of finance. Now, viewers and students, we discussed this compound interest. Compound interest involves a change in the principal every period. The interest of the previous period is added to the principal. Now we have this calculator formula for this compound interest plus I will show you the table also. The simple formula is future value is equal to present value multiplied by 1 plus I raised to the power n, where future value is FV, PV is present value, n is equal to periods, I is equal to interest. Now if you see the principal, first principal at the end of, rather we start at the first year, beginning of first year we had this $100 or 100 rupee, whatever you feel like. So now what happens is after the end of the year the interest is charged at 12%. So interest is put in, added in that. So the interest 12% is calculated here. The value for the first 100 is 12 and the value becomes 112 in the end of first year. In the second year, the first year and principal becomes the main new principal and this 12% is charged on this new principal. So our value becomes 125 along with the interest and everything. Similarly, this 125 becomes the third year new principal. So interest same 12% on this principal. Now we have this, the value of this interest value is 115.05. Similarly, we have the balance on the this 140. The same 140 becomes the new principal of fourth year, right? Now you understand this compound interest. This formula is being used also for calculation of, this is easy way to calculate this value. Let's say you want to value this fourth year value. Fourth is your n, right? I is your interest. This is your interest, right? You put the value straight away in this formula, raised to the power n. Now fourth is a year, so we raise this to the power 4. The value becomes 157. There is another simple method which I am going to tell you in the next page. If I get you the value of this part, so you simply multiply your $100 with this, and in the fourth year, or let's say 12% interest, in the fourth year you have 12% interest, and your main present value today is 100 rupees. So what is the value at the end of fourth year? So this will be 157. I will solve the same case next page, where we have another easier method to calculate your future value of a simple amount. With the concept of compounding, let's define future value, which is the value which comes after compounding the interest rate. Now, the future value is the value of money at a future date based on an assumed rate of growth. That means rate of growth means the same interest. The future value is important to investors and financial planners as they use it to estimate how much an investment may be made today that will be worth whatever is required by them in future. Knowing the base, knowing the future value enables the investors to make sound investment decisions based on their required needs. The formula is given here, that is future value equals to present value multiplied by 1 plus I divided by 100, the whole raised to the power n, where I stands for interest and n stands for period. To understand this future value of simple amount, now we'll consider one example. We know the mathematical formula is future value is equal to present value multiplied by 1 plus I, the whole raised to the power n. Now we have, let's say I have $100 today. How much it would be of the 4 years? How do I calculate it? The simplest method is the calculator, but in calculators the chances of making mistakes, if you are like me, are more. So we solve it like this. Now if the interest rate is 12%, years are 12, years are 4, interest rate is 12%, 4 years. So how do we solve it? By the calculator method also we have solved. It comes to 1.574, and when we multiply it by 100, this factor becomes 157.46. So this is the value of money you will get after 4 years if you have 12% rate of interest after 4 years. This can be further easily solved by tables which are easy and are shown in the next page. Same example, I will solve it through this future value tables which are easily available on the computer also and in the books also, and you are allowed to use it in the exams. Now I discussed this is the future value table of $1. Now this is a period, and that means a year, where this is n also in your mathematical formula. Similarly, this is the rate of interest I. Yeah, it's now easy to understand. So our problem now, we have $100 and our interest rate is 12%. Our year is 4. We follow the table on the 12%. You see, I get this figure 1.574. This is the value of, if the present value had been 1. So your value would have been 1.574. Now the present value is 100. So we multiply this factor 1.574 and with 100, and you get 157.4 value, which is the same in the previous page. You see, this is more easier way to solve rather than a calculator. If you're good at it, good. But if you're like me in mathematics, maybe you might make mistake. So this table is an easy way and accurate way to solve this. Now discussing the same future value of an amount, let's go to a little different problem now. Let's divide these interest payments biannually, or maybe we can divide them quarterly also. That means every 3 months a part of payment is there. But the interest rate, remember, is always named after 1 year percentage. That is subdivided further into quarterly or biannually for later for these kind of problems. Now here, let's say we have an interest biannually, same $100. So everything remains the same, only the n changes to 8, because every year we have 2 installments multiplied by 4 years, that becomes 8. Similarly, in the interest also, every year we have 12%. So 12% divided by 2 after every 6 months, because after every 6 months we'll have to pay or give 6% on that, right? So the formula becomes future value 6% with n 8 equals to 100 multiplied by 1.594. It's nearly the same but a little higher than the annually compounding. Now viewers, we have this present value also, exactly like future value. The present value is exactly the opposite of future value. Future value is the amount of money you require at the end of certain year or future. Now, how much to assess this future value, how much money to invest today to get the advantage of interest, to get that future money in, let's say you require after some time. So this is this method. The exact definition is present value is current value of a future sum of money or stream of cash flows given a specified rate of return. This rate of return means the rate of interest, right? Now, from coming back from future cash flows to present value, now this is called discounted at that interest rate. So this is called discount rate. The lower the present value of a future cash flow, the higher the discount rate. The formula is given by present value equals to future value divided by 1 plus r raised to the power n. You can see in the table below also the same thing is worked here by formula. You require, let's say, for 1000 after 4 years with 12% rate of interest. The present value will be 635.52 by mathematical formula. This can be solved by tables also, which is shown in the later slide. Let's solve this present value of a future value question. Now, the mathematical formula is given here as previously explained. Now, let's assume my son needs $1,000 at the end of year 4 for his university education admissions now. And so I save today. How much do I save today with the prevailing interest rate of 12% per year annually? Same formula, we have the result. Now we can get this value of 1 by 1.12 present value from a table also, and it will be easier to solve. That is given in the next page in the same manner. Now let's see this table. This is called the present value table. Now we have this 12% interest rate. This is the 12% interest rate, and we have 4 years. We get here the figures 0.636. If we multiply this 0.636 by 1000, we get 63,636. That is nearly rounding in the same figure that we had in the previous question, previous slide. So this is the way we solve the present value through tables. Now let's start, boss, with the same question. Now we have n equals to 16 now, and interest percentage is 3% now. That is, it's quarterly. 12% divided by 4 is 3% per year, per month rather, per third 3 months. So we combine this with, this comes to 0.623. This 0.623 when multiplied by 1000 will become 623, which is the same as the answer taken by the calculator. Now, students, I end this my lecture today, and the view kindly refer my parent channel, that is Mindbenders 172, for more knowledge videos, and subscribe if you are here for the first time. I am going to start a new channel, Lesson Pair, for my lectures and specifically for my educational channel, which will be running in a due course in a few days. Kindly refer to that also if you need some more knowledge items. For all your queries, you may contact my email given here or WhatsApp number.